Welcome to Griffonomics.
Thanks for having me back.
So, when you usually picture a massive construction site, you just think of brute force, right?
Oh, yeah,
Yeah.
absolutely. It is all raw power.
Like the physical power, the dust in the air, the sheer noise of those massive diesel engines.
Right, just yellow iron moving thousands of tons of earth.
Exactly. I mean, it really
So,
feels like the last truly analog industry left on the planet.
it does. It is so visceral.
You pull a heavy steel lever and hydraulics engage and dirt moves. It is as physical as human labor gets.
It is a completely tangible environment. I mean, for decades, this entire sector has been defined by heavy machinery and diesel fuel.
Yeah, and raw steel.
Right. It has operated in this silo that historically feels completely disconnected from, the broader economic shifts.
Like the shift towards software and algorithms.
Exactly. The prevailing mindset was always just, well, you can't exactly code a trench into existence.
You literally just have to dig it.
Right.
But if you look closer at how modern billion-dollar mega projects are actually being built today, that purely analog picture completely fractures.
It really does. The physical reality is still there, obviously.
Obviously, yeah. But we're looking at a landscape that is being quietly but radically rewired by this invisible layer of data.
And that is the transition happening right now.
Right, and that massive transition is the core mission of today's deep dive. We are generating a very granular strategic report and investment roadmap.
Specifically focused on a company called Equipment Share.
Right, trading under the ticker EQPT. We're going to unpack how they are fundamentally dismantling the traditional equipment rental sector.
It is one of the most fascinating industrial shifts currently underway, in my opinion.
Totally. To get to the absolute bottom of this, we're pulling from a massive stack of source documents today.
We have a lot to get through.
We really do. We are pulling apart their recent Q4 and full year 2025 earnings call transcripts.
As well as diving deep into their Form 10K SEC filings.
Yep. And synthesizing several strategic investment reports from major banks. Plus, we are dissecting the press releases from their January 2026 NASDAQ IPO.
That IPO was a massive event.
It was huge. And, if you are allocating capital in the industrial sector, you need to care about this.
Or even if you are just trying to understand the next wave of technological disruption.
Right. Because this isn't just a story about backhoes and bulldozers.
Not at all. It is a highly specific blueprint for how a legacy fragmented industry is being rewritten.
By what the market is calling the SaaS plus steel model.
SaaS plus steel. I love that framing.
It is a massive high alpha growth opportunity, but it introduces a very unique structural set of risks.
Because it blends two totally different economic models, right?
Software and heavy physical assets.
Yep.
And traditional valuation models really struggled to price that accurately.
Well, the phrasing of SaaS plus steel is the architectural foundation of their entire business model.
It really is.
It is the only lens through which you can accurately evaluate their valuation and their growth trajectory.
Right, because if you evaluate them purely as a rental company, the multiples make no sense.
Exactly. And if you evaluate them purely as a software company, the massive capital expenditures make no sense.
So you have to synthesize the two.
You have to.
Let's start by establishing the true identity of Equipment Share then. Because we have to shatter the assumption that this is just a traditional rental yard.
Right. It is not just a chain link fence and a gravel lot.
With a bunch of tractors waiting for someone to walk in.
No, not at all. To understand their identity as a disruptor, we really have to rewind to their origins.
Which are actually pretty different from the typical Silicon Valley story, right?
Very different. The company was founded around 2014 and 2015 by two brothers, Jabek and Willie Slacks.
And they weren't software engineers?
No, they were actual contractors. They had spent years grinding in the field managing crews.
Dealing with the physical realities of moving dirt.
Exactly. So they were intimately familiar with the friction of the industry.
Because they lived it.
They did. And they were deeply frustrated by the systemic failures of visibility on job sites.
Like what kind of failures?
Well, in the traditional construction world, a massive problem is equipment hoarding.
Hoarding. Like hiding tractors.
Literally, yes. A foreman on one side of a massive site might have 3 excavators sitting idle for a week.
Just doing nothing.
Just sitting there. But because he knows he will need them next Tuesday, he hides them.
Because he doesn't trust the rental supply chain to deliver them on time.
Exactly right. Meanwhile, a foreman on the exact same site but on the other side is halting work.
Because he doesn't have an excavator.
Yeah. So the Schlex brothers were watching machines sit idle. They had zero visibility into actual machine utilization,
And their projects were bleeding margin because of it.
falling behind schedule every day.
So it is the classic entrepreneurial origin story. They solved a pain point they personally bled over.
Right, but they didn't start by taking out a massive loan to buy $1 billion worth of equipment.
They actually started incredibly lean right as a peer-to-peer marketplace.
Yeah, they won a startup weekend in Columbia, Missouri.
Oh, wow.
And that momentum actually got them accepted into Y Combinator.
That is wild for an equipment company.
It is. They built a platform designed to let contractors rent their own underutilized machines to other local contractors.
So it's basically the Airbnb model applied to yellow iron.
That is exactly what it was. And it was a very clever wedge to validate the demand for equipment visibility.
But that wasn't the final form, obviously.
Yeah, the true inflection point, the moment they shifted to a structural threat, happened when they executed a massive pivot.
Because the pure peer-to-peer marketplace just wasn't enough to solve the deep operational issues, right?
Right. The friction of moving a 50,000-pound machine between two random contractors was just too high.
Quality control would have been impossible.
Completely impossible. So they made this incredibly capital-intensive decision to become a vertically integrated operator.
Meaning they actually bought their own fleet.
They built a physical distribution network, yes. But they built it native to a proprietary technology platform.
The T3 platform.
Exactly.
Let's focus on that pivot. Because becoming a vertically integrated operator in heavy machinery is terrifyingly expensive.
Oh, it requires billions.
But they didn't just build a rental company. They built T3, which functions as the actual operating system for the construction site.
Which is where the SaaS plus steel concept really takes shape.
Right, and to understand that, we have to look at their customer profile. The SEC filings show a massive 89 to 90% of their 2025 rental revenue comes from mega projects.
Which are national and regional customers. We are not talking about a local landscaper renting a wood chipper for a weekend.
No, definitely not. So define a mega project for the listener.
A mega project is a massive infrastructure build. Think of a multi-billion-dollar hyperscale data center.
Or like a next-generation semiconductor plant.
Exactly. Large-scale renewable energy installations or huge federal highway expansions.
Those environments are insane. The logistical complexity rivals a military deployment.
It really does. You have thousands of pieces of heavy machinery and tens of thousands of workers.
And dozens of independent subcontractors all operating simultaneously.
Right on a footprint that can span thousands of acres. So the focus on these mega projects is a deliberate strategic choice.
Because it makes the T3 operating system an operational necessity rather than just a luxury dashboard.
Precisely.
To really conceptualize the difference, think about enterprise computing. The traditional rental model is like buying physical servers for an office.
Right. You buy the hardware, you rack it in a closet, and it's your problem to maintain it.
Exactly. It is a completely disjointed transaction.
Yeah.
But Equipment Share's approach is like the shift to Amazon Web Services.
AWS, yeah, that is a perfect analogy.
When a massive contractor partners with EQPT, they aren't just taking delivery of physical excavators.
They are plugging their entire job site into a unified cloud-based ecosystem.
Right. They get the physical machines, but they also get the overarching digital infrastructure.
An infrastructure that governs utilization, predicts maintenance, and tracks labor.
It transforms renting from a one-off procurement task into a continuous service layer.
And you really see this integrated service layer in action when you look at their specialty division.
Right, because they have moved far beyond just moving dirt.
Way beyond. In 2025, their specialty segment grew by a massive 34% year over year.
Wow, 34%. What exactly does the specialty division do?
They provide the critical life support systems for a mega project.
Good.
So massive industrial climate control and HVAC systems.
Primary and backup power generation, right?
Yep. Complex fluid management, electric pumping networks, and industrial compressed air.
And financially, those specialty items are the holy grail.
Oh yeah, because they carry significantly higher margins than standard dirt-moving gear.
I mean, an excavator is somewhat of a commodity.
Yeah.
But a highly engineered, site-wide dewatering pump system is a specialized solution.
Exactly. They're embedding themselves as the single-source utility provider for the entire site.
Okay, but wait, let me push back here. Let's inject a dose of reality.
Sure.
Moving dirt is moving dirt, right?
Mm-hmm.
A bucket goes into the ground, it lifts, it rotates, it dumps. The physics haven't changed in 100 years.
Yep.
So why on earth do we need to inject a highly expensive software layer just to manage a tractor? Isn't this just over-engineering a simple process.
That skepticism is super common, especially from industry veterans.
Right, it sounds like a tech solution looking for a problem.
It does, but that view severely underestimates the financial gravity of modern construction delays.
Okay, break that down.
Let's look at the mechanics of a failure on a $2 billion semiconductor plant build.
All right.
If you have a massive trenching operation underway and a critical 80,000-pound excavator blows a hydraulic pump.
Which happens all the time.
All the time.
Yeah.
But it is not just a minor inconvenience for one operator. It triggers a catastrophic cascading failure.
Across the critical path of the project.
Exactly. If that excavator goes down, the trenching stops. If the trench isn't finished that day, the concrete contractors scheduled for the next morning can't pour the foundation.
Oh, wow. And then the steel crews are delayed.
Right. The structural steel crews scheduled for the following week are delayed. You suddenly have dozens of highly paid subcontractors standing around waiting.
And the daily capital burn rate on a mega project can easily exceed $1 million a day, right?
Easily. So the complexity of these modern sites demands digital visibility.
Visibility that can predict and prevent those bottlenecks before they actually happen.
Precisely. The cost of downtime isn't just the cost of replacing the hydraulic pump.
It's the millions of dollars in cascading schedule delays.
Exactly right.
Which leads us directly into the technology itself. We know they are targeting these mega projects.
Right.
But how do they actually execute this? How does the technology lock these highly demanding customers into the ecosystem?
This brings us to the T3 ecosystem, the invisible layer.
And that invisible layer dictates their entire competitive advantage.
It is the definitive moat of the company.
Yeah.
And the single most brilliant architectural decision they made was making T3 aggressively OEM agnostic.
OEM agnostic, original equipment manufacturer agnostic.
Right.
Explain the mechanics of why that specific technical decision is the linchpin.
Well, if you look at the legacy giants in the rental space, their business models are deeply intertwined with specific premium brands.
Like Caterpillar or John Deere.
Exactly. A major competitor might have a decades-long partnership with Caterpillar, so their internal tracking software is highly optimized for SAP machines.
It communicates with the proprietary telematics of those specific machines.
Right. But a general contractor managing a mega project does not operate a homogeneous fleet.
Never. They operate an incredibly fragmented mixed fleet.
Yes. They might have a JLG aerial boom lift a Bobcat skid steer, a massive Doosan excavator, and a Genie scissor lift, all in the same zone.
And if the software can only talk to the CT machines, the site manager is basically blind to 70% of the site.
Functionally blind, yes.
So, EquipmentShare designed T3 from the ground up to ingest data across any piece of equipment regardless of the manufacturer.
Right when EquipmentShare purchases fleet inventory, they prioritize buying from whichever manufacturer offers the most robust open API.
So they refuse to be beholden to the iron.
They are entirely loyal to the data architecture.
That is brilliant. And T3 actually takes it a step further, right?
It does. It doesn't just track the rental gear that EquipmentShare provides. T3 is designed to ingest the contractor's entire operational footprint.
Wait, so a contractor can install T3 trackers on their own internally owned fleet?
Yes, they can. The platform also integrates with their labor management systems to track worker hours.
And it can even track material deliveries.
Exactly. It condenses the absolute chaos of a mixed fleet project into a single real-time dashboard.
That is a fascinating psychological play. They are providing the software to manage the equipment the contractor bought from someone else.
They're making themselves absolutely indispensable to the entire operation.
Let's dive into the actual data telemetry, because we aren't just talking about a blinking GPS dot on the map.
No, definitely not.
The filings detail predictive maintenance capabilities, powered by highly trained AI models. Walk through the physical mechanics of how that works in the field. How does software stop a machine from breaking?
It relies on what they call a sensor-to-server architecture.
Sensor to server.
Yeah, modern heavy machinery is essentially a rolling data center. EquipmentShare is capturing the native high-frequency data directly from the machine's engine control unit.
The ECU.
Right, the ECU. We are talking about granular telemetry, engine oil temperature profiles, fuel, rail pressure, battery voltage degradation.
Even hydraulic fluid viscosity.
Yes, and even the micro behaviors of the operator, like how often they are redlining the engine.
Or engaging safety overrides.
Exactly. And because EquipmentShare has been capturing this dense data layer for over a decade, They have trained highly sophisticated AI models.
Models that aren't just looking for a simple check engine light.
Right, they are looking for microscopic, seemingly unrelated anomalies.
Give me a concrete example of what that anomaly looks like.
Okay, imagine a massive articulated dump truck operating on a site in Texas. The AI model detects that over the last 72 hours, the engine's peak operating temperature has increased by just 3 degrees.
Just 3 degrees.
But only when the machine is operating on a specific incline, and it correlates with a very slight drop in hydraulic pressure.
A human mechanic would never, ever notice that.
Never.
Yeah.
But the AI model has seen that exact data signature 10,000 times before.
And it knows what it means.
It knows that specific signature means a primary cooling valve is going to crack in approximately 48 hours.
So the software flags the impending failure before the physical component actually breaks.
Precisely. And the operational workflow that follows is where the massive return on investment is realized.
Right, because instead of that dump truck suffering a catastrophic failure in the middle of a crucial haul, spilling fluids everywhere,
And stopping the site while a tow truck is dispatched?
T3 proactively generates a work order.
Yep. Equipment Share dispatches a mechanic with the exact replacement valve to the machine at 2.0 a.m. while the site is dormant.
Oh, wow. So the part is swapped and the machine is ready for the morning shift.
And the contractor never even knew they were 48 hours away from a massive delay.
That is the invisible layer in action.
It is incredible.
And the filings note that they estimate this AI-driven capability reduces unplanned downtime by 25%.
A 25% reduction is huge.
On a mega project where the daily burn rate is astronomical, eliminating 25% of unplanned mechanical failures translates to millions of dollars in protected margins.
And guaranteed schedule acceleration.
Exactly. Which brings us to the ultimate financial output of this technology, the SaaS multiplier.
This is the holy grail of their business model.
It is the structural core of their economic moat. When a massive construction firm adopts T3, the switching costs become prohibitive.
The data from their earnings call quantifies this beautifully, actually.
Yeah, national accounts that are highly engaged with T3 spend roughly 6 times more on equipment rentals than non-users.
6 times the revenue capture just by getting them to adopt the software.
That perfectly illustrates the extreme stickiness of a platform business.
Once a major contractor goes through the agonizing process of digitizing their entire workflow.
Right, integrating labor tracking, migrating maintenance schedules, loading their own fleet data into T3.
The thought of ripping all of that out is horrifying.
Transitioning back to a disjointed ecosystem of spreadsheets and whiteboards is just operationally painful.
And financially risky.
It is exactly like the iOS ecosystem on your smartphone, right?
Oh yeah, perfect example.
If you are embedded in the Apple ecosystem, your iPhone, your iPad, your MacBook are perfectly synced.
Your photos are in iCloud, your passwords are saved.
Right. Family location sharing is all set up. If you switch to an Android phone, you aren't just swapping hardware.
You are abandoning your entire digital workflow.
And your operational memory. So if a mega contractor switches away from EQPT to a cheaper local competitor, they lose their entire site dashboard.
They lose the predictive maintenance and the unified labor tracking.
The loyalty this dynamic creates is incredibly rare in the industrial sector.
Very rare. And the financial reports highlight that over 75% of first-year revenue at newly opened EQPT locations comes from existing loyal customers.
Wait, 75% of first-year revenue at new sites comes from existing customers?
Yes. Customers who are actively following them into new geographic markets.
That is insane. The customers are literally pulling the company's expansion strategy forward.
It is a highly organic growth engine. The customer basically says, hey, we just want a bid to build a factory in Ohio. We need you to open a yard in Ohio because we refuse to run this project without T3.
Wow. But this massive expansion introduces a fundamental financial friction.
It definitely does.
Developing proprietary AI software requires tens of millions in R&D.
Yep.
And simultaneously buying billions of dollars of heavy physical equipment and opening hundreds of yards requires an astronomical amount of capital.
Astronomical is the right word.
It begs the central corporate finance question. How does a company grow at a 40% plus compound annual growth rate in a heavy asset industry without collapsing under corporate debt?
Which brings us to the most fascinating financial engineering aspect of this enterprise, the OWN program.
Right, because the traditional legacy rental model is just brutal on the balance sheet.
Brutal. In the old model, you go to the corporate bond market, borrow $1 billion at a hefty interest rate.
You buy a massive fleet of excavators and pray that utilization stays high enough to service that massive debt load.
And you just hope you squeeze out a margin.
But equipment share is bypassing that entirely through the OWN program.
which is a highly innovative capital-light financing model.
Break down the exact mechanics of how this works.
Okay, so the OWN program fundamentally alters the capitalization structure of the fleet.
Right.
Instead of relying purely on corporate debt to finance every single machine, Equipment Share basically crowdsources the capitalization of their fleet.
To institutional markets.
Exactly. They utilize their centralized purchasing power to buy new equipment directly from OEMs at steep discounts.
Okay, they buy the machine.
They take delivery. But instead of keeping that asset on their own balance sheet and taking on the debt, they immediately sell that equipment to a third-party investor.
And we are not talking about retail investors on an app, right?
No, no. Highly sophisticated pools of capital. Institutional credit funds, large family offices, and high-net-worth syndicates.
So these institutional investors purchase the actual physical asset.
Yes, they hold the title.
Okay, then what?
And then the investor executes a specialized agreement to lease that exact equipment right back to Equipment Share.
Oh, I see. So Equipment Share takes the machine, puts it into their rental fleet, and manages 100% of the operational life cycle.
Exactly. They manage the deployment, the AI predictive maintenance, the rental execution through T3.
They treat the machine exactly as if they owned it themselves.
Right. And when that machine generates rental revenue on a job site, Equipment Share takes a management cut.
And the remaining revenue flows back to the third-party investor as yield. It is essentially an industrialized scale sale-leaseback model, but it is entirely powered by the tech platform.
It is a beautiful structure.
Let's look at the staggering scale of this program, though, because this is not some experimental side project.
Not at all.
They closed the 2025 fiscal year with $4.9 billion of original equipment cost, or OEC, under management, specifically within the OWN program.
$4.9 billion.
And to give you context, their total OEC across the entire global company was $8.78 billion.
Right, so that means significantly more than half of their entire managed fleet is actually owned by third-party institutional investors.
That is wild. Billions of dollars of heavy machinery moving dirt today owned by family offices.
It has become the indispensable engine of their geographic expansion.
And it has matured into a highly durable capital market platform.
The ultimate validation of that came in December 2025.
Right, when they executed that massive $454 million asset-backed securitization transaction.
The ABS transaction, yes, that is a highly complex financial maneuver.
They basically pooled the future cash flows from a massive tranche of these OWM program machines, right?
Exactly. They structured them into risk-rated bonds and sold them to heavy-hitting institutional investors like MidOcean Partners.
With the entire deal structured and underwritten by Citigroup.
Right. The successful execution of a nearly $500 million ABS proves that sophisticated institutional capital has stress-tested this model.
They've verified the T3 data and are highly confident in the predictable returns.
Exactly.
So from a pure corporate finance perspective, why is this specific structure so brilliant?
It executes a massive transfer of risk. It completely shifts the heavy debt burden of fleet acquisition off of Equipment Share's balance sheet,
while simultaneously allowing them to maintain 100% operational control.
They still capture a significant portion of the rental revenue. They still control the relationship with the contractor.
And most importantly, they are still collecting every single byte of telematics data through T3.
Yes. They achieve all the operational benefits of scale, but they strip away the traditional leverage risks that bankrupt legacy companies during recessions.
But hold on, let me push back. If more than half of their entire fleet is actually owned by a family office in New York, isn't this entire narrative just a tech-washed way of saying they don't own their core product?
That is definitely the most common initial critique from value investors.
Doesn't that just make them a middleman? Like a highly leveraged broker of heavy equipment?
It sounds like it, but it fundamentally misunderstands where the defensible value lies in the modern economy.
Okay, explain that.
The value is no longer in simply holding the title to the physical iron. Anyone with a credit line can buy excavators. The steel itself is a depreciating commodity.
Right. The SaaS plus steel concept in its purest form.
The true high-margin value is in the proprietary data generated by that machine and the sticky customer relationship managed through the software.
The steel is fungible. The SaaS ecosystem is the moat.
Exactly. Furthermore, the T3 platform is the sole reason the OWN program functions at scale.
Why would a sophisticated credit fund buy a $400,000 machine, hand it to an operator, and trust them?
Because T3 provides unprecedented transparency, the investor can log into their portal and see exactly where their asset is geographically.
Oh, so they can see its minute-by-minute utilization rate.
They can review its entire AI-managed service history and watch the rental revenue accrue in real time,
That transparency completely mitigates the operational risk for the investor.
which ensures the institutional funding keeps flowing to fuel EQPT's expansion.
The technology enables the transparent financing. The financing enables the physical scale without crippling debt. And the scale feeds more data back into the technology.
It is a massive, self-reinforcing flywheel.
Incredible. With the architecture of the business model clear, let's open the ledger.
Let's look at the numbers.
We need to review their full year 2025 numbers and dissect the massive capital inflection point that occurred with their January 2026 IPO.
The 2025 financial performance was exceptionally strong. It provided the empirical validation for their high-burn growth strategy,
They reported $4.38 billion in total consolidated revenue.
which is a solid 16% year-over-year increase.
But total revenue can be noisy. The critical metric is the rental segment.
Right, the core engine of their long-term value.
The rental operations alone generated $2.72 billion in revenue. That is a staggering 34% year-over-year growth rate.
Achieving 34% organic growth at a $2.7 billion scale in a mature, capital-heavy industry is almost unheard of.
It really is. But as you dig into the revenue mix, there is a fascinating strategic nuance.
Yes, the equipment sales.
Right. While rental revenue exploded, their equipment sales revenue actually dropped by 8% year-over-year.
Coming in at $1.54 billion.
To a casual observer, a drop in sales looks like a failure. But management made it clear this was an intentional, disciplined allocation of capital.
It is a critical indicator of their long-term strategy, actually.
Because in the legacy business, companies frequently sell older equipment to end users to grab a quick revenue burst, right?
Right, clear inventory, get a cash hit.
But EQPT actively chose to throttle that secondary market sales channel.
Instead of selling those machines for a one-time hit, they funneled them directly into the highly oversubscribed OWN program.
They are prioritizing long-term recurring rental revenue over short-term quarterly sales spikes.
It demonstrates a management team focused on compounding value.
And that discipline is paying off. They reported a GAAP net income of $40 million for the year.
But in this industry, net income is incredibly flawed because of massive depreciation charges.
Right. The metric the street actually relies on is adjusted core EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Exactly. And for 2025, their adjusted core EBITDA hit a record $1.67 billion,
Which is up 32% year over year. The core engine is humming.
which sets the stage perfectly for the January 2026 IPO on the NASDAQ.
The IPO was the ultimate de-risking event for the entire corporate structure.
They priced it aggressively at $24.50 per share.
And the market response was voracious. The stock popped 19% on opening day.
They successfully raised a total of $747 million in fresh capital, bringing the market cap well over $6 billion.
It was a massive headline.
But look past the sheer size of the check. What does that $747 million actually do for the structural health of the company?
The singular vital impact is massive leverage reduction.
Okay, let's unpack that.
Prior to the IPO, equipment share was running the balance sheet extremely hot. Their reported net leverage ratio was 3.2 times EBITDA.
3.2 turns of leverage in a cyclical industry is a high-risk profile.
Very high beta. If the economy stumbles, the interest payments become suffocating.
But when you inject the $747 million of pure equity proceeds and pay down the most expensive debt, their pro forma net leverage ratio immediately dropped.
To a much healthier 2.4 times EBITDA.
Dropping nearly a full turn of leverage overnight is a massive sigh of relief for investors.
It creates an enormous structural buffer to survive a downturn.
And management paired the equity raise with a strategic debt restructuring, right?
Yes. Leading up to the IPO, they dismantled their existing credit facility and replaced it with a massive new facility led by Wells Fargo,
Pushing debt maturity dates all the way out to 2030.
completely removing any short-term refinancing risk and lowering their cost of capital.
So they stepped onto the public markets with an optimized capital structure.
Absolutely.
Now let's talk about where they are deploying this massive pool of capital. Because their growth strategy requires relentless reinvestment.
Very heavy reinvestment.
In 2025, they spent an astonishing $252 million purely on opening 95 brand new market locations.
That is scorched earth geographic expansion.
But to understand why they would willingly burn $250 million just to open lots, you have to understand the J-curve.
Right, the unit economic model of a new location.
Walk through the exact month-by-month financial physics of opening a new location.
Okay, so when they identify a new market, say outside of Phoenix, they typically commit about $2.5 million of upfront capital over the first 12 months.
This is phase one.
Right, phase one, securing real estate, navigating zoning permits, building out T3 diagnostic bays, recruiting specialized mechanics.
And seeding the yard with inventory.
Yep. So throughout year one, that specific location is deeply cash flow negative.
It is purely in an investment phase, dragging down overall margins, the dip in the J.
Exactly. As they cross into year two, the dynamics shift.
The local customer base builds and fleet utilization climbs.
Sometime during year two, the yard generally crosses the break-even threshold.
But the true financial magic happens at the 24-month mark, right?
Yes, the exponential upward curve.
The 24-month mark is when the accounting classifies a site as officially mature.
And the margin profile of these mature sites is where the entire valuation is justified.
The numbers are staggering. By the end of 2025, they had 186 mature locations across the country.
And those 186 sites collectively delivered a 54% adjusted EBITDA margin.
54% margin. And a 16.5% return on invested capital.
Generating 54% margins in heavy equipment rental is astronomical.
That is the operational leverage waiting to be unlocked. Let's connect the dots.
Yeah.
They just spent $252 million opening 95 new sites in 2025. Today, those 95 sites are in year one bleeding cash.
Dragging down corporate profitability.
But as the calendar turns and those 95 sites age into month 24, that massive cash drag will violently reverse.
They're going to start throwing off enormous amounts of free cash flow at a 54% margin.
With very little incremental upfront investment required.
It is a textbook high-growth reinvestment cycle.
As long as they survive the year one burn, the year three returns are massive.
Right. But of course, no company operates in a vacuum.
No, definitely not. The equipment share is going head-to-head against massive legacy giants who have dominated for decades.
We have to evaluate the competitive landscape.
We are looking at a market effectively governed by a massive duopoly. United Rentals trading under URI and Sunbelt Rentals trading under SUMB.
To understand EQPT's specific moat, we have to contrast their philosophies.
Let's start with United Rentals, the apex predator.
United Rentals is the undisputed behemoth. Their strategy is built on overwhelming brute force and geographic route density.
And ruthless consolidation, right?
Absolutely. They want a delivery truck on every highway corner and a yard in every zip code.
Their primary engine for top-line growth is massive serialized acquisitions.
They just buy up successful regional competitors to dominate market share.
Because of that scale, they cater to massive federal infrastructure projects that demand instantaneous equipment availability.
Right. But they do have a software component, too.
Yeah, they heavily market a system called Total Control.
But Total Control is fundamentally different from T3. It is primarily an advanced fleet management tool designed to track equipment rented specifically from United Rentals.
So it remains a closed ecosystem.
Exactly. It is not an OEM-agnostic full-site operating system.
So URI is the logistics powerhouse. Then we have Sunbelt Rentals, SUMB. They are the cash engine of the industry.
Sunbelt is a masterclass in asset efficiency. While URI spreads a massive net, Sunbelt operates a cluster strategy.
A cluster strategy, like focusing on specific metro areas.
Right. They identify highly lucrative hubs like Atlanta and aggressively saturate that cluster with multiple overlapping yards.
They want to completely dominate a regional market to deliver machines faster and cheaper.
But their true financial moat is asset lifecycle management.
The hyper-optimized buy-rent-sell cycle.
Exactly. Sunbelt maintains premium partnerships with gold standard brands like CT and Deere. They willingly pay a premium upfront for these machines.
They run them hard for a few profitable years, and then what?
Because they are premium brands with pristine records, Sunbelt sells those aging machines on the secondary market for absolute top dollar.
They extract maximum residual value out of every single asset,
making their model incredibly cash efficient.
So URI focuses on sheer scale. Sunbelt focuses on regional cluster dominance and resale efficiency.
And then equipment share enters as the tech platform.
Bypassing the legacy arms race entirely.
Yeah.
They differentiate by focusing obsessively on the software layer first.
Acting as the invisible partner, targeting middle market contractors and tech-forward mega projects.
It is three totally different approaches attacking the same customer base.
And what makes this industry so unique is the operational dynamic between these rivals.
The frenemy dynamic, or co-opetition.
Exactly, because despite fighting fiercely in boardrooms, they cooperate extensively in the field.
Let's talk about the concept of re-renting. Because to an outsider, the idea that rivals would supply each other with inventory seems completely absurd.
It seems absurd until you understand the punitive nature of failing a mega project client.
Walk through the mechanics of a re-rent.
Imagine United Rentals secures a master contract for a $5 billion airport expansion.
Okay, crown jewel contract.
Suddenly, the contractor demands 50 specialized excavators by Monday morning to meet a deadline.
But URI only has 40 available.
Right? If they fail to deliver those final 10 machines, they breach the contract and risk losing the account forever.
So they are trapped. What do?
They pick up the phone and call the local branch manager at Equipment Share or Sunbelt.
And they execute a wholesale re-rent agreement.
Yep. URI quietly rents the 10 excavators from their direct competitor at a wholesale rate and provides them to the client seamlessly.
The client is thrilled. EQPT is satisfied because they secured guaranteed revenue without marketing costs.
And URI protects their massive master contract.
Is a massive hidden symbiotic ecosystem.
And this cooperation extends beyond just moving iron. They collaborate on regulatory issues via the American Rental Association.
The ARA, right. They pool resources to lobby for safety regulations.
And they created the standard equipment taxonomy.
That is vital infrastructure. It ensures a 19-foot scissor lift is universally recognized across everyone's software.
It proves they all benefit from a rising tide. A standardized market helps everyone.
Okay, we have spent the bulk of this deep dive analyzing their brilliance and execution, but to maintain total analytical integrity, we have to pivot hard.
We need to look at the bear case.
We have to dissect the structural, macroeconomic, and technological vulnerabilities of this company.
Absolutely. The necessity of stress testing this model cannot be overstated.
Right, and to be clear to you, the listener, we aren't taking sides on market pricing or predicting a crash. We are objectively analyzing the SEC risk disclosures.
The first and most glaring vulnerability is macro-cyclicality.
Because despite the brilliant software, EQPT's revenue is fundamentally tied to the physical execution of construction.
Which is brutally cyclical. If the physical world stops building, T3 doesn't generate rental revenue.
If a general contractor goes bankrupt, the site shuts down.
Exactly. If inflation spikes, driving up raw materials, or if the Fed aggressively raises interest rates, making loans prohibitively expensive.
Or oil prices plummet, crushing the energy sector.
The ripple effects are immediate. Mega projects pause, capital expenditures freeze, demand for equipment plummets.
Leading to an oversupply of idle machines in yards everywhere.
Companies slash prices depressing daily rental rates. EQPT's top-line growth would hit a brick wall.
So they are heavily dependent on total construction spend.
Yes. The second major risk is a deep structural dependency on the OWN program itself.
The engine that fueled their growth.
It is a double-edged sword. EQPT relies heavily on institutional investors to fund fleet expansion.
They are tethered to the health of institutional credit markets.
If those markets dry up due to a banking crisis or economic panic, EQPT loses its primary low-cost vehicle for scaling.
If the ABS market freezes, they can't securitize assets.
They would be forced to halt expansion, sacrificing market share, or take on massive, expensive corporate debt.
Destroying the capital-light nature of their model.
Exactly. Which leads to the third risk, their beta profile and relative leverage.
The IPO brought leverage down to 2.4x. But context is everything.
Sunbelt operates with a highly conservative, fortress-like net leverage ratio of just 1.6x.
So even after a massive equity raise, EQPT is still carrying significantly more debt relative to earnings.
Making it a high beta play. In a booming economy, 2.4x amplifies growth, but in a severe recession, that elevated debt burden consumes free cash flow fast.
They have a much smaller margin for error.
Right. And finally, they carry unique tech sector vulnerabilities.
Because they operate as an IT infrastructure layer, essentially.
Yes. When your entire competitive moat is based on being the infallible digital nervous system, the consequences of technological failure are catastrophic.
Like a prolonged SaaS platform error.
If a bad code update takes T3 offline for 48 hours, they functionally blind contractors across thousands of sites.
Predictive maintenance stops, labor tracking fails. The liability would be immense.
And even more critical is the risk of a cybersecurity breach.
Because T3 holds proprietary architectural layouts, detailed labor hours, physical security analytics.
If that data is breached or held for ransom, it shatters the trust that forms the foundation of their moat.
A contractor will not put their $2 billion data center on an insecure OS.
They are fighting a dual-front war, securing physical iron while deploying enterprise-grade cybersecurity in the cloud.
It is a difficult needle to thread. All right, we've covered the disruptive upside, the OWN program, and the sobering macro risks.
It's time to synthesize this into the final verdict, looking at the 2026 horizon.
When you weigh the T3 stickiness and the scalable OWN program against the macro risks, the overarching strategic outlook is definitively rated as high alpha growth.
High alpha meaning potential for massive market-beating outperformance, but with structurally higher volatility.
Look at the explicit forward guidance. They expect a massive 27% year-over-year growth in the rental segment for 2026.
Aiming for $3.3 to $3.6 billion in pure rental revenue.
And they fully expect total consolidated revenues to cross the $5 billion threshold.
Hitting $5 billion while maintaining 27% growth is phenomenal.
But what truly underpins this rating is a hidden strategic lever in the filings.
The average age of their physical fleet.
Explain why fleet age is the ultimate lever here.
EQPT's fleet age is incredibly young, sitting at just 30 months across the portfolio.
Compared to legacy peers averaging 50 to 60 months.
Right. When you combine a 30-month fleet with the $1.34 billion in available liquidity they secured, it grants the team the ultimate ability to pivot.
So if the economy roars, they can aggressively expand CapEx, buy thousands of machines, and capture market share.
But if the bear case materializes and a recession hits, they don't have to buy a single new machine.
Because the fleet is so young, it isn't breaking down.
They can instantly pause CapEx, turn off the purchasing valve, and let the young fleet age over the recession.
The cash outflow stops, but the rental revenue continues to flow in.
They instantly transform from a cash-burning growth engine into a massive free cash flow generator.
A beautifully hedged operational position. It's built for maximum speed, but has incredibly robust brakes.
Precisely.
Well, that brings us to the end of our analysis. We've tracked an incredible journey from a peer-to-peer startup to a $6 billion juggernaut rewiring how the physical world is built.
It has been quite the deep dive.
Before we close, I want to leave you, the listener, with a broader provocative thought.
Let's hear it.
If this SaaS plus skill model is this financially devastating to legacy incumbents, if an invisible layer of data can fundamentally change the unit economics of physical steel, what other industries are next?
That is the big question.
Look around at other capital-heavy fragmented sectors operating on legacy systems, like global maritime shipping and port logistics where containers are still tracked on Excel sheets.
Or large-scale commercial agriculture.
Exactly. Commercial aviation maintenance or the fragmented North American freight rail network. Which of these legacy industries is operating blind, just waiting to be eaten alive by a T3-style invisible layer?
The disruption of the physical world by digital operating systems is just beginning.
And EquipmentShare has just open-sourced the blueprint. Risk defined, portfolio protected,